Hey everyone, welcome back to my channel. And today's guest, I am welcoming a good friend of mine, Sam Norris, the property investors broker and director of Grand Union Finance. So Sam, thank you so much and welcome to my channel.
Oh, absolute pleasure to be here, mate. Always good to see your face.
Awesome. Yeah, it was a pleasure to have you on, mate. And today, for everyone who is watching, we are going to be talking about everything finance, which is what Sam's speciality is. So we're going to be able to sort of really dive into what finance can be accessed at different stages of where you are in your property journey, or perhaps you're just starting out and you want to know what availability there is for you to get on the property ladder. So Sam, if you're happy to sort of just give us that 30,000 view of what finance is really in the property world and what options there are.
Well, thanks, mate. Well, look, I think where I sort of sit in the market actually is quite a good position to be able to look at quite a large spectrum of different types of property finance, because most brokers, and there are about 8,000 registered in the country at the moment, most of those, at least 4/5, I would say, focus in on your standard residential mortgages, which most people watching this video will know quite a lot about just because they'll see adverts in the news and all that kind of stuff. Where I focus in on and where investors are going to find more value is in the more specialist types of finance. So yes, you have mortgages, very similar to residential mortgages, buy-to-let mortgages. Even they can have various different types of security. So you might have a standard buy-to-let, which is your single let. You're going to have an HMO, house of multiple occupancy, where you might have more than one individual residing within one home. You've got serviced accommodation now is a massive thing with a staycation boom. So that's short lets and holiday let options. And you've also got things like social housing. So you've got lots of investors now might rent their property to a social housing organization on a longer lease. And that again needs a very, very specialist type of mortgage. Sometimes a commercial mortgage, which is something else that we also look at. So mortgages for commercial entities as well. In between those, there's other various different types of finance. We do a lot of bridging finance, which, as you know, is a short-term finance option to allow you to acquire a property that maybe is unmortgageable or a property that needs quite a lot of renovation. So you just need to acquire that nice and quickly. Maybe you're buying at auction as well, because it can be set up quite quickly. We also do a lot of development finance. So finance where not only are you borrowing against the value of the asset as it is now, but against the asset of what it's going to be worth in the future, and having the finance options available to actually be able to bridge that gap and help you do the work to create a much more valuable asset. So no matter what kind of property project you're looking at, there is a finance product for that. And we haven't even talked about kind of business finance and that sort of stuff as well, which a lot of my clients are utilizing as well, obviously with CBILS loans and things like that, but also other creative business finance and business loans that are available now to property investors potentially to help them with their businesses too. So it is quite it's quite a specialist world now. It's not where it was sort of 20, 30 years ago, where it was mortgages or basically a two-man band bridging loan shark organization. It's a little bit more sophisticated now, shall we say.
So there's a lot of options now.
Massive, yeah, loads.
A lot of options. And essentially, to sort of summarize really what it is it's filling that gap for those who can't complete with the full amount. And I suppose really someone like yourself, Sam, will come in and look at the circumstances, look at the background of that certain person, and then try and fill that gap with some form of a bridging loan, some finance in between. So really, for anyone who is watching, perhaps, I mean, Sam, actually, you're probably best to answer this question. Do you find that you have newer property investors coming to you, or would you say that even still some of the old school guys who might even have the cash that they still like to leverage finance?
Do you know what? I've got clients I've been working with for 10 years that have been doing this for a long time, but I also get a lot of inquiries from completely brand new investors. And their concern a lot of the time is, because I don't have any assets, because I don't have any experience, can I still access finance? And the answer is yes. You just can't necessarily access the same finance as somebody that might have been doing it for 20 years or whatever. So I think for me, it's understanding the difference between the different types of lender criteria and what their policies are and who they'll lend to, and actually just trying to get into the mind of a lender and think, well, why would they lend to me? Because that's the ultimate thing here is the lender's risk assessment of you And do they believe they're going to get their money back with their interest within the allotted time that they have mapped out as the term of that particular loan? So understanding that, I think for a lot of people watching this will probably allow them to maybe understand a little bit better as to why certain lenders will work with them, some lenders won't.
So on that, so obviously going on to what qualifies someone. So anyone watching this thinking, okay, I want to get onto the property ladder, I may have a deposit, whatever it might be. So that is a question that I imagine comes up quite a lot, is let's answer that first. Do you need to own your own property to access a bridging finance or some sort of finance to complete on a buy-to-let? Do they have to own their own property?
Fit that in too. Let's talk about bridging first, then let's talk about mortgages afterwards. So bridging is a lot more flexible. It helps, I won't lie. There's three things really that a bridging lender's looking for, and I'll put them in order of priority from a lender's point of view. Let's say that we're getting a bridging loan because we want to follow that buy, refurbish, refinance model. So there's going to be a refurb involved. First of all, they want to see that you've got some sort of experience maybe doing this. You don't necessarily, that doesn't mean that you own another property right this very second, but you can highlight that maybe you've done it once or twice before, you've project managed that kind of refurbishment. That's going to be top of their priority list because that will give them the most amount of comfort. And that's the C word we're looking for here, comfort, in being able to get their money back, and they'll have they'll believe in your ability to be able to do that. The next one under that is assets. So that can come by way of your own home. It could come by way of a larger portfolio. A lot of my clients aren't actually homeowners in the traditional sense because they might live in London, for example, where it's very expensive to buy property, a home for yourself, but then invest in Leeds or Bradford or the Wirral or all these places up north where you can actually get a higher yield. So it's actually better from a cash flow perspective. But they won't necessarily own their own home. So owning assets in the background, especially those assets with equity available in them, is also seen as a sort of a secondary importance in terms of what bridging lenders are looking for. The last one is actually income. Although they won't necessarily be too concerned with how much that income is, unless you want to service the debt, and with bridging loans not getting into too much of the nitty gritty, most of the time you pay the interest up front or it's deducted from the loan, so there's no monthly payments. But if you choose to make those monthly payments, then they'll want to see that you've got a certain amount of surplus income to cover those. But generally speaking, it's there, again, using the C word, it's a comfort. I had a client early this year, 2021, that had no experience, no assets at all, but they had a six-figure income. And I was able to kind of get the lender to understand that actually that should give them enough comfort to be able to lend them the money, because they had more than enough surplus income that if something hit the fan, so to speak, they were going to be able to jump in and help out. So owning your own home, having experience, that kind of stuff, yeah, they help. But if you didn't have any one of those, there are still, believe it or not, bridging lenders that you can access. You just won't be able to access the whole of the market when it comes to bridging lenders. So that's sort of the bridging side of things. But with buy-to-let mortgages, it is a little bit different. They are a little bit more kind of tick boxy in their policy and their criteria. So the vast majority of lenders are going to want to see that you own a property. In fact, recently we had, and it's all dependent on who's sort of top of the tree in terms of their pricing. But it just so happened that the lender that was offering the best 5-year fixed rate on a buy-to-let for limited companies was a lender called Pepper Money. And we were doing some research for a client. They came up, brilliant. This is going to work perfectly for this particular client. He had 3 buy-to-let properties, checked on their policy. They have to be a residential homeowner with a mortgage to qualify for a mortgage with them. Personally, I think that's ridiculous. If you've got 3 other properties, you quite clearly know what you're doing, like, from a buy-to-let point of view. So that gives you an idea from a home ownership perspective. There are lenders there that even if you own other property, if you don't own your own home, they're still gonna disqualify you from working with them. On the whole, if you're a first-time buyer, first-time investor buying with a mortgage, you really do have a handful of lenders. Some of those will do an affordability assessment very similar to a residential mortgage on you to make sure you can afford it. And they will also want to see that, you're not in commuter distance potentially to this property. So it's not like a backdoor residential, because it is a little bit easier to get a buy-to-let than it is a residential. And a lot of people used to use buy-to-let mortgages when they couldn't afford to get their own residential home as a way of getting themselves a home, basically. So you just have to make sure that, again, we come back to the same word, comfort, giving the lender comfort that you're not doing that, but your market is very, very, very reduced from a buy-to-let point of view, which is why I think a lot of my clients, when they're building portfolios, maybe that first one, although it might seem incredibly risky and quite scary to buy your first ever property with a bridging loan, as long as you're getting the right advice, you're using the right lender, you understand what you're doing, you've worked out all your figures, actually that might offer you or afford you more options when it comes to the refinance element of that, because at that point you are then a property owner and the lender options available to you are just so much more. So I know that was quite a big answer to your question, but it kind of breaks down how that would work from a first-time buyer perspective.
No, that's awesome. Well, there's two questions off the back of that. So one, just quickly on the income. So if someone has a big income, I assume, obviously an income can be lost at any moment. I would assume they would have to provide the lender with X amount of dates of that income being brought in.
Yeah, so from a bridging point of view, a lot of this, so to start with, it's a comfort thing. So we're just ticking a comfort box to start with, which is, do you have an income? Yes, we do. Excellent. That makes us feel better about lending you money, because if something goes wrong, we know that you've got a backup. It only really comes into play in terms of proving that income and delving into it a little bit more when a borrower might want to pay the interest on a bridging loan on a monthly basis, at which point we just need to show, let's say, for example, that the interest being paid on the loan each month was £1,000. We would just need to provide them with bank statements to prove that there was a rolling surplus each month of £1,000 to be able for them to afford it. They don't delve into it as much as they would on a mortgage, because they just want to see the basics. Do we feel comfortable that you can pay us that amount each month? Yes or no?
Awesome. And then the second question off the back of that is, if someone has a larger deposit, say, they've got slightly more in the bank to put down on their first buy-to-let property, obviously that's going to give them more leverage. So I take it, if they have a bigger deposit, but they only need to bridge a smaller amount, the options would be slightly wider in terms of what they could access with a bigger deposit.
Absolutely, yeah. So we've got to be a bit cautious about sort of loan size here, because generally speaking, in the bridging market, I'm not saying that they're greedy. They've got margins they want to hit, and generally speaking, putting together a bridging loan of 50 grand is the same sort of level of due diligence and work as it would be for 500 grand. And you're not going to make anywhere near as much money on those two differing amounts. So being wary of minimum loan size, theoretically the problems start occurring below 100,000. The less you borrow, the better. I actually had a client recently who wanted to go down the route of getting some development finance for a refurb project. And I kind of said to them, because I've been working for them for quite some time, shoot myself in the foot, because I get paid as a percentage of how much they borrow. But I said, you don't need to do this. We got them on a 60% bridge instead, 6% loan to value. Lender didn't ask for a valuation, they just did an online valuation. So that sped up the process and saved them probably about 1,500 to 200,000. 2,000, not 200,000. The due diligence was a lot less than it usually would be. And they're also a little bit more flexible when it came to the legals on certain things as well. So instead of it being maybe a 5 to 6 week turnaround, which would have been standard for that particular lender, it was about 3.5 weeks from start to finish. So there are lots of other positives from putting down a larger deposit. Obviously, there is the opportunity cost of not having that cash available for another project. But if it's your first or your second, chances are you're not going to be overlapping your projects anyway. So putting more of your eggs into one basket, I don't think is necessarily going to be a bad thing from that perspective. Definitely will put you in a better position from a finance point of view.
Awesome. Cool. Well, moving on to sort of the questions around security, because obviously we kind of covered this up a little bit in terms of you wouldn't need to necessarily own your own home. But if there is a higher amount of security, again, I would imagine that increases your chance of leverage to what you can access, borrow. So for most people, they might be in the pool of they don't own their own home, but they're looking to take out that bridging loan. So to sort of answer that question, I take it the security will be placed onto the project in question. So if they're looking to do that, the lender can take the security on that. And that's how that this bridging loan can work for those who don't own their own home, right?
Absolutely, completely. So it's very similar to a mortgage in many ways, to be honest with you, because it is a loan secured against a bricks and mortar at the end of the day. Where there might be a little bit of additional flexibility with a bridge when it comes to the security is for 99.9, in fact, off the top of my head right now, I couldn't tell you any mortgage lenders that will actually do this. Wouldn't do this, but is they will lend based on the lower of the value or the purchase price. So if you're buying a property at 500 grand and they're going to lend you 75% loan to value, they'd lend it on 500 grand unless the valuation came in lower than that, in which case they would lend on that figure. If the valuation came in higher than 500 grand, they're not going to lend you on that. Now, with a bridge, we can do what we call open market value bridging, which means that if you do have a slightly smaller deposit than maybe is necessary, we can actually look at, and we've actually got 3 of these on the go at the moment, believe it or not, where the client is buying a property that is genuinely below the market value. And there's various reasons for this. We've got one, for example, that is looking, it's an inherited property. They need to get the money out really quickly because they've got some school fees that they need to pay. So first world problems, but so we need to sort of get this through. They've offered a big discount on the value of the property as a result, and so the lender is actually able to lend on the value of the property, the genuine value of the property, even though the purchase price is lower than that, which obviously then reduces the deposit that's needed. So there's that flexibility there. So that's where the security becomes really important. We can, although I know in the example you just mentioned, you've said this is the first property that they're buying. If they did have other property in the background, we can leverage the equity that's in there as well in 2 different ways. We can do it by way of a second charge, which is quite a formal loan against that property. They would have to let the first charge lender know. They would have to give their authority to do that. 90% of lenders are pretty okay with that. There'll still be loan to value maximums and stuff like that, but it does mean that potentially you could actually end up borrowing 100% of the purchase price. And we've done that a few times. The exit is important. You need to make sure that whatever you're doing is going to be enough to repay all the loan and everything like that. But it is entirely possible. You can actually also do something called a comfort charge or a tertiary charge, which is where some lenders can place a charge, although it's not it's not going to show up on too many records. It's just going to be sort of a legal agreement between everyone that there is a comfort charge on a property as well. The first charge lender does not need to authorize it, does not even need to be made aware of this. And that can sometimes just mean that sometimes, say, for example, we're going to a slightly higher loan to value on the security property. What a lender might say is, well, look, let us take a comfort charge over this other property in the background, and we might be able to take that up to 80% or 85% loan to value instead of being restricted to the traditional 75%. So there's loads and loads of creative ways. What I will say as a kind of not a warning, but maybe just a subtext to this is, and it's weird a broker saying this, is don't over leverage yourself unnecessarily. These options are here to allow you to make, basically they're tools. So they're there to allow you to grow your portfolio, move yourself forward maybe quicker in your property journey than maybe you would normally, but don't do it unless you absolutely have to. Unfortunately, I've come in at various different stages where people have over leveraged. I had an unfortunate situation at the beginning of 2021 where a client came to me after I'd spoken to them the previous year and said, don't do what you're going to do. I don't recommend you leveraging. I don't recommend you doing this and all that kind of stuff. They were over leveraged. Their property value had actually gone down, and they'd come to me saying, oh, what are we going to do now, Sam? We've taken out this loan, even though you told us not to. What's our situation? And I said, you need to sell that property ASAP, and you're actually in negative equity right now. So you probably need to take out a second charge against your home as well to pay it off. So you bought a property to try and improve the quality of your life. And it's actually diminished it. So, these are the dangers of finance. And I would say the finance itself isn't dangerous. It's actually usually it's like finance is a sword. A sword's only dangerous if the person wielding it is doesn't know what they're doing with it and they poke someone's eye out. If you know what you're doing with it, it's a really good tool to enable you to move forward. And so the finance itself isn't the dangerous thing. Generally, it's the borrower who is actually the risk. And I say this to clients all the time. They say bridging is risky. I said, no, you're risky. If you don't understand bridging, and if you don't understand how the figures work, and you haven't done your due diligence on what the value of this asset is going to be once you've done a refurbishment to it, so you then come to refinance it and you don't have enough to pay off the bridging loan or whatever it might be, or you've got an investor and you haven't got enough to pay them off, that's on you. That's got nothing to do with the bridging, because the bridging finance is taken out on a day-to-day basis by hundreds of investors up and down the country, most of which are very, very, well advised, and they know exactly what they're doing with it, and they use it to, in a really good way, and it allows them to become more successful. Where bridging doesn't work, generally it stems back to the original borrower not getting the right advice, not listening to the right advice, or not doing enough due diligence to make sure that it is the right product for them, or the right project for them, to be honest with you. So sorry, I went off on a little bit of a tangent there.
It's all good. I mean, there's a pattern here for anyone listening that if you haven't noticed already, there's a pattern. And I would, I work in finance as well, and I would agree. It's comfort. As we keep coming back to, it's comfort. So, I think to sum it up, really, you can access this finance in one way or another, but you really have to look at your situation and really evaluate. And I'm actually going to use an example. When you were talking about the over leverage, I would really agree with Sam, is that for anyone watching, and these are similar conversations to what I have with some people that want to borrow, and really push the boundaries, is I had a long time ago, I was helping a friend move some stuff. He owns a removal company, and I was helping him move some stuff. This is years ago. And we were in a lift that could only take 700 kilos. And we pushed the limit up to we were at about 650 kilos, and the lift cut out. So it's obviously totally different, but the meaning is still the same. Is we over leveraged that lift, and the lift cut out, and we were in there for hours. So over leveraged, and really pushing the boundaries of what you can borrow is actually increasing your risk. So absolutely agree with that. So Sam, for anyone watching, I want to paint this picture for what's this typical perfect scenario of what a new property investor could access finance. What would be, if you could say, anyone watching, if you could have 25,000 in cash, do this, do that, what's kind of the perfect scenario for someone looking to get on? What should they have?
Yeah, it's actually quite a tricky question to answer, and it's just because there are just so many different finance options and different ways of doing things. But I guess for me, when you're starting out, I think that let's talk about the over leveraging just very, very quickly again. Don't push yourself. We've got products, refurbishment bridge products, if I can get my words out, where lenders will go to 85% loan to value if they can see that there's going to be an uplift in value of the property. It's available, but does that mean you should take it out? Remains to be seen. I believe first project, keep it simple. Put down a decent sized deposit if you can. Try not to overcomplicate it by using multiple assets. A good nice 30 to 35% deposit is actually going to get you quite far. Most lenders are going to want to deduct that interest, as I mentioned. So even if your lending is a 75 to 70% loan to value on a bridge, if they're going to be deducting 9 months worth of interest, let's say, if your term is 9 months, plus maybe their lender fees and maybe a few other bits, maybe some legal fees, that is going to bring that net loan down to around the sort of 60, 65, 70% loan to value bracket. So you're going to have to make up that difference in the deposit. But again, using that C word, comfort, the more money you're putting into it, the more lending options you are going to have. So I think deposit size when it comes to bridging is as if not more important than when you're looking at a mortgage, because it will open up more lending options. It will open up more, will improve your terms, which ultimately then improves your bottom line. And when I'm talking to first time investors and we're going through the project they're looking at from a finance point of view, we're looking at a few key things, which is what it's actually, a lot of it is not down to the cost of the finance whatsoever, because the cost of the finance to a degree is irrelevant as long as all of these other figures all stack up. So we're looking obviously at how much they're going to be purchasing this property for. We're going to be looking at how much the works are going to cost you, what that's then going to lead to in terms of an end value. We call that GDV, gross development value. Even on a small project, just get used to using the terminology GDV. It's what the professionals use. I hate the word done up value. That really grinds my gears. But we're then looking at the rental income that if you're going to be keeping it on a sort of buy, refurbish, refinance type strategy, what's the rental income going to be when you come to refinance it? And then using those figures, we can then work out A, what the cost of funding is going to be, B, how much money you're going to need to put into the deal when you include stamp duty, other fees, deposit, that cost of works that we mentioned. How much we're going to be able to get on a remortgage, because we're going to see that GDV, 75% of that gives us our remortgage. We usually stress test that at 4%, just to give us a little bit of leeway. And then we can use out the annual rental income compared to the the money that you potentially might have to leave in the deal. A lot of people talk about money in, money out deals, or recycling cash. A lot of the time on these BRR, buy, refurbish, refinance strategies, these projects, you're not quite getting all your money out of these deals anymore. So it's all about then working out how much of your money that you put in is being left in. That's an important amount, because you can basically then work that out. In my mind, the way I see it is, however much money you leave in, you can use that as a comparison to how much money that would be left into a different project or a different investment strategy, or even just being left in the bank in a savings account. And then what we can do is we can use your net cash flow once we've taken away your annual expenditure, i.e. rent, mortgage, to your annual rent. And we can use those figures to work out a return on the cash that's left in the deal. We call that return on cash invested, or ROCI. And that percentage, that is going to give you your figure to make the comparison between this investment and another one, or this investment and another non-property investment elsewhere. And I think from a first-time investor's point of view, that's actually the key figure for me. And if it's around the 20 to 30% mark, that's your sweet spot. That's where most investors are aiming for. They're trying to get to that. Any advance on that, and you've got yourself a really nice deal. And the reason why I go through all of that is you might have noticed that I haven't mentioned interest rates once throughout all of those figures. And that's because if you're hitting your 20 to 30%, the interest rate is absolutely irrelevant, because how much you're paying for the funding has not had a negative impact on your return on your capital invested. So there, as a first-time investor, I know I've sort of thrown quite a lot of figures there at you, Aaron, and at the people watching. But they're the things that I go through with a first-time investor. They're all the figures that you need to know what they are. I have a spreadsheet where I've got formulas and stuff, and we go through them, we put them all in, and it spits out, the figures that we need. We need to know how much money you need to put into the deal. We then need to know what your return on your capital invested is going to be and how much you're leaving in that deal. And also, it's just nice to know as well what your net cash flow is likely to look like, because ultimately most people are trying to build portfolios to potentially remove the need to work in the future. They're replacing their income. So knowing what your cash flow is going to be, even at a stress tested interest rate of 4%, is good to know. It's probably not going to cost you 4%. It might cost you 1% less than that, which obviously is good. But they're the things that new investors need to be looking at. And as I said, you said sort of what's the perfect scenario? The perfect scenario is that all of those then match up to getting you to about 20 to 30% return on your capital invested, because that's when you found yourself a good deal. And also, they're the figures that lenders look at to make sure they're comfortable that it's a good deal as well. Because ultimately, if you're not actually making a decent return, lenders know this. They analyze deals. They'll look at it and they'll go, "It's not a great deal. Don't really want to lend on it." Even if they know that they're going to get their money back, they might just go, "If something goes wrong here, this is easily going to go into single digits on a return, which is going to potentially put a risk on getting our money back." So that's the key for me, is that return on capital invested.
Awesome. Nice detailed answer there, mate, for anyone watching. So sort of finishing off onto sort of wrapping it up, I know we spoke about this off camera. What is your 3 top most questions that you have come through? What do you get all the time? What are the top?
Do you know, this was the question I wasn't looking forward to the most, mainly because I get so many questions thrown at me constantly. I think one of the ones that pops up a lot is, can I buy a property with a brand new limited company? And I think the reason why I get asked this a lot is purely because, and this is no one's fault, these people don't, you don't know what you don't know, is a misunderstanding of what a limited company actually is from a property perspective. It's simply a vehicle for ownership. It's nothing more than that. The term limited company is old-fashioned. Your liability is not limited anymore. You will be signing a personal guarantee. So the answer to that question, can I buy a property with a brand new limited company, is absolutely yes. Believe it or not, I've submitted applications for bridging where the limited company hasn't even been set up yet. On the terms, it literally says lender TBC. Sorry, not lender, borrower TBC. And that's because it's completely irrelevant. But ultimately, it's all down to the individual and all those things that we spoke about earlier in terms of the tick box list of things they want to see. It's all down to the borrower. You're going to sign a personal guarantee. The responsibility of the loan is on you. Let's be completely honest here. The only reason that people do it is purely it's for tax. It's for tax reasons. Some lenders don't make you sign a personal guarantee anymore. But to be honest with you, they are in the vast minority. So if you're going to be buying a property in a limited company, it can be absolutely brand new. Makes no difference. It doesn't need to show a history of accounts, anything like that. As long as it's set up at some point during the course of the application, great. For a mortgage, it needs to be set up before we can apply. But for a bridge, yeah, I've got terms out on bridges where it's borrower TBC, which is actually quite funny when you see it.
Awesome. And what's number 2, and then on to 3?
Number 2 is often about, when it comes to buy-to-let mortgages, how much income do I need to get a buy-to-let mortgage? And again, this is you don't know what you don't know. A lot of it is, I think, a misconception of that residential mortgages and buy-to-let mortgages are similar. The only real similarity between the two of them is the fact they're both called a mortgage, really. Because when it comes to how much you can borrow, on a residential mortgage, it's obviously down to your income, your expenditure, your surplus income, and your affordability. When it comes to a buy-to-let mortgage, it is down to the income that the property generates. The rental income dictates how much you can borrow, and lenders will generally use a rental stress test calculator to work that out. So, as a standard calculation, whatever you want to borrow, the lender will stress test how much you will pay on an interest per month at 5.5%. So imagine your interest rate is 5.5%. What would your monthly interest be on, what would your payment be on that amount? And then your rent would need to be 125% of that figure. That's the standard rental calculator. There are lots of deviations to that depending on circumstances, but that's the one. When I'm on a call with a client and they're chatting away to me, I've got my calculator next to me and I'm doing that calculation straight away just to say, okay, we haven't got a problem there. We're not going to be limited by lenders because we need to find one that's going to be more flexible. So that's what dictates how much you can borrow. As a completely separate point, I think this is where the confusion comes. Some lenders will have a minimum income requirement, and all that is so my way of how I kind of compare this is, it's a little bit like when you're applying for a job and it says that you need a 2-1 at university. Most of the time you don't need to have a 2-1 at university in order to actually do that job. All they're doing is they're just reducing down the number of applications they're going to get for that job, and lenders are doing exactly the same thing. We want you to show a £25,000 income. Well, all that does is it just mitigates their risk in needing to then do more due diligence on that person's personal financial circumstances. Because if you've got 25k a year, then generally speaking, they're going to go, right, most of the time they're going to have a surplus income of X, which should be enough to cover void periods on a property of this size. So that's all that is. So generally speaking, I think the worst case scenario in the market is 30,000. So if you want access to every single lender in the market from an income criteria perspective, you've got £30,000 provable income, you've got no restrictions whatsoever. There's only one that has that, by the way. Next down is 25. There's a lot more that are at 25k. Next one 20. Next one 15. I think there's only one or two at 15. And then under that, there are certain lenders that don't have a minimum income requirement, but that's not to be confused with not needing to have any income at all. You still need to show some income, but those lenders will work that out on a bespoke basis. And generally speaking, with some of those lenders, I've got applications through where the client has only got 2 or 3 grand's worth of provable income per annum. And because the property is strong, it's not made a difference. So all it does is it just kind of restricts your lending options if your income isn't up to 20, 25, 30k a year. So that's kind of like one of my big questions I get asked a lot is, how much income basically do you need in order to get a buy-to-let mortgage? And it's a little bit more complicated than just how much do I need. It's split into those sort of 2 categories of understanding what actually constitutes a buy-to-let mortgage, basically.
Awesome. Number 3, mate. What's the final one?
Yeah, this is a tricky one because they're the top 2, and then under that I get like hundreds. But I think one that I get asked a lot is about development finance quite a lot, because I think what people don't understand about development finance is just sort of how the loans are worked out. So I'll get in various different guises. The same question is basically, how much can I borrow on development finance? And the answer to that is actually, it's down to the end value. It's down to the GDV. And most lenders, what they will do is they'll say, well, we can lend up to 70%, let's say, of the GDV. So if your GDV is going to be $1 million, that means that they could potentially lend you £700,000. Now, what makes that more complicated is that's the maximum that they can lend you, but that isn't necessarily what they're actually going to lend you. And this is where it becomes a bit more complicated, and I'll go into a bit more detail. So that loan side, that potential overall facility of 700,000 is then split into 2 sections. We've got our section that covers the cost of the works. We call that our development facility. And then we've got our loan that is used to help towards the purchase. We call that our day one advance. So first of all, the lender will work out what their development facility will be. Whatever the cost of works is, so let's say it's 300,000, they'll cover that in as the first port of call. They'll then add into that development facility probably a 10% contingency, so another 30,000 on top of that. They'll work out how many stage payments roughly that you're going to be making. Maybe they'll lend that to you in 4 or 5 tranches, and they'll work out how much it's going to cost to send the quantity surveyor. So this is the person that will go to the site to check that you're on schedule and to go and revisit those sites. They'll work in how much that's going to roughly cost, and they'll add that into the development facility as well. So that's covered. They'll then work out approximately how much interest is going to need to cover the cost of that loan. Now, with development finance, you only pay interest on what you've actually drawn down on, which makes it a little bit tricky at the beginning because we don't know when those stage payments are actually going to come in. But let's say it's an 18-month term on the development finance. On average, a lender's probably going to say, well, you're probably going to pay about 10 months worth of interest overall on that total amount. So they'll add in then say 10 months worth of interest on that. All of that money then becomes our development facility. We take that away from our overall loan facility, that 700,000 that we spoke about earlier, or 70% of GDV. Whatever's remaining can contribute towards the purchase price. However, that is going to be limited on a traditional loan to value basis. There are some lenders that can be a bit more flexible, as we were talking about earlier, in terms of the open market value bridging type thing. But let's say for this example, it is going to be based on the purchase price. So if your purchase price was 200 grand and the maximum they can go to day one is 75%, that means 150,000 can contribute towards it. If your overall facility is 700, your development finance facility is 500, which means you have 200 left over. That doesn't mean that you have 200 that can go towards the purchase. It's still going to be limited to 150, which is why I said sometimes it's a bit of a misconception of that loan to GDV. Oh, I can borrow that now. No. That's the maximum they'll go to, but let's then work backwards to work out what the actual loan's going to be, which means that then the loan to GDV might actually only be 60%, which could end up working in your favor because that might actually mean that the terms are better because you're borrowing less. So it's quite a complex. What I've just said there is actually, believe it or not, a simplistic version of how these loans are worked out. But that's kind of how we do it. We start with the end, we work backwards, and we work out then what is borrowed. So key things there are overall loan facility is based on the GDV, the end value. It's then split into two sections, a development facility and a day one net advance. Those two combined cannot be more than the loan to GDV maximum. Generally speaking, if it's a good project, they won't be anywhere near it. They're probably likely to be more 60%, which is actually a really good indicator as to whether the project's a good one or not. If the overall loan to GDV is less than, say, 65, 60%, it's actually a decent project because it shows that the uplift in value of the site is actually pretty significant compared to the outlay at the beginning. So, as I said, I know that what I've just said there sounds quite complicated, and I've just made it sound stupid because I said it's an oversimplistic version of it. But that, in essence, is how development finance is worked out, and that's, yeah, I'd say probably that's my third most asked question. I'd say is how does development finance work?
Yeah, that's awesome, mate. And it's a great detailed. And look, anyone that's watching this is, is guaranteed to come away with a lot more knowledge than what they did when they started this video. So, it's all good. Love it. Sam, just before we wrap up, did you want to give your socials a shout out? Where can people reach out to you?
Yeah, pretty much everywhere online. You can find me at the Sam Norris, just so that people don't get confused with any other random Sam Norrises out there. So I'm on Instagram, Twitter, TikTok, Facebook, LinkedIn, all under that handle. And I also have my YouTube channel. If you type in Sam Norris in the search bar, I come up first. I check that fairly regularly just to make sure that I definitely do. So you'll find me on there. And I do actually have a video on there specifically about how to work out your development finance. So basically what I just said there, but just in a little bit more detail if people want to go and check that out.
Awesome. Well, it's been a pleasure to have you on, mate. I'm sure we'll do this again sometime. And for everyone
Always
watching, yeah, thanks for joining both of us. And do hop over, do give Sam a follow, a like and a subscribe. And also for my channel if you did enjoy the content. So until next time, Sam, thank you very much. And I'll see everyone all very soon.